Well, Goldman Sachs, which famously coined the term BRICs to identify the key emerging market countries cherished by investors, announced this week that it was closing its flagship BRICs fund. With continued economic troubles in Brazil, Russia, and China, is the era of the BRICs over? And what about emerging markets? On set now to discuss further, we have Sam Chester of Clarity Capital. Thank you so much for being with us.
It's a pleasure.
Well, how is this acronym ever really helpful?
Well, certain things haven't changed since 14 years ago when the term first came to be. In the last 14 years, 2 of the countries of the BRICs are democracies, 2 of them are still not democracies, 2 of them are major commodity exporters, China and Brazil, and 2 of them are commodity importers. And at the same time, the wealth in the different countries is very different. I mean, you're talking about countries like Brazil and Russia, where average wealth is over $10,000 per head. You're talking about China, where it's about $7,000, and then India, where it's less than $2,000. So those facts, broadly speaking, have not changed. That said, if you look back 14 years ago, why was this term coined to begin with? It was coined in Goldman Sachs, as you mentioned, and at the time, it was coming from post 9/11, when there was a sense that the global economic future that we're looking at over the next few decades was going to be a non-American future, where these key emerging nations were going to, through their linkages, define a lot of trends that investors wanted to look at. So that's really where it came to be at the time. And in terms of, is its demise, meaning is the term no longer helpful? Well, let's just put it in one note, which is the countries themselves, the four BRIC nations themselves, they've really embraced the term. I mean, they've held conferences on an annual basis.
Well, it's a huge thing here for brand reputation. They're essentially creating brands here for themselves.
For sure. So from the country's perspective, the term will remain in use. The question, of course, is for investors, how much is this relevant?
Right. And so they're closing this fund here. How significant is that?
So Goldman's decision to close the fund is attracting a lot of press, mostly because Goldman was the one who first coined the term and for the last decade has really been championing it. But let's just be very clear, it's not only Goldman who have been withdrawing money from investing in the BRIC nation or BRIC funds. Over the last year, 2015, $1.5 billion has been withdrawn from investing in BRIC funds. Since about 2010, when the BRIC economies first started faltering and growth slowed, we've seen upwards of $15 billion being withdrawn from investment. So it isn't only Goldman. The reason Goldman did it, of course, is because since 2010, when the growth topped off, they've lost over 88% of the value in this fund. If the fund's not earning any money, the fund is going to close.
Right, and you're bringing up this point that this is a trend that we've been seeing for some time to come. What's ahead, though, with this upcoming rate hike here? The emerging markets, such as these BRIC countries, are expected to feel even more pain.
Well, the rate hike that the Fed is looking at is certainly seen as a challenge to emerging markets. Emerging markets across the spectrum, the indexes have been down, and really developed economies is where savvy investors have been looking at for the last few years. That said, if you're trying to take sort of a bigger picture and say, is this the end of the BRICs as we know it? Is this perhaps not the end of the BRICs? I think one key lesson to take from this is that from 2000, 2001, when the term came into use, until about 2008, the world saw a boom in commodities and in credit that we've really never seen before in recent history. And the ones who took advantage of that, of course, commodity exporters like Brazil and China, the credit crisis had helped all these countries in the emerging nations, particularly the BRICs. The problem is that these 4 BRIC nations didn't take advantage of the good years to do necessary reform. I mean, India right now is awash in needed reforms, which is threatening to slow its encouraging growth. Russia faces major recession. Brazil is facing major political crisis and obviously a major economic crisis. And we all know the story in China, which has its growth has been slowing, and recent data suggests that with Chinese exports slowing by up to 20%, that the Chinese economy is going to continue to slow. So one of the lessons to take from this, and why people predict that really maybe the BRIC era is over, is that during the good years, they didn't do the reforms that are necessary, and therefore how now that their economies are facing more difficult years, challenging years, are they going to implement the needed reforms? I mean, when you think of the last few years, where have some of these countries put their money? Well, the Olympics are a good example. China in 2008, Russia in 2010, Brazil now in 2016. That's billions and billions of not necessarily the best use of infrastructure investment that could have gone to much better causes.
All right. Well, what does this all mean for investors?
Well, I would give it as a 2-part answer. One, what does it mean for emerging markets? Emerging markets are down, but there are still jewels in the rough. You look at countries like Turkey, you look at Eastern Europe countries like Poland, you look in Southeast Asia, Thailand and Malaysia. Emerging markets shouldn't be written off completely. For investors, though, the key lesson here is diversify. Goldman Sachs is not really closing their fund, but they're expanding it into a more diversified emerging market fund. That's the key for any savvy investors. That's really what you look for professional investment advisors to provide you with, is a diversified fund and perhaps a little bit more focus on the stronger developed economies.
Indeed. Well, that is the name of the game, diversification. Thanks so much for being with us, Sam Chester of Clarity Capital. Very much a pleasure.